Welcome to the deep dive. Today, we are grabbing our 20-sided dice and diving into the world of Hasbro Inc.
Right, the company behind Monopoly, Nerf, a lot of classics.
Exactly. But the story today isn't really about those classic toys anymore, is it? It feels like it's all about this massive digital pivot they're trying to pull off.
That's the core of it, yeah.
So we're digging deep into a stack of sources today, including a pretty detailed research report from Compasscope to see if this strategy actually holds water. Our mission is, well, pretty straightforward. Let's unpack Hasbro's strategy, look at the big risks, and get a handle on the financial health of this global play company right now.
And I think what's really critical for you, the listener, to grasp right from the start is the central tension. Hasbro is definitely transforming.
Moving away from just toys.
Exactly. They're shifting from being seen mainly as a traditional toy maker to what they're calling a diversified, digitally forward play company. So this deep dive really means we have to look at their two main operational segments separately. You've got the legacy toy business, stable, maybe struggling a bit.
Right.
And then you have this high margin digital growth engine. The whole future of the company kind of hinges on understanding that split. Hashtag tag one, company business and lines of businesses.
Okay, let's unpack that shift then. Fundamentally, Hasbro is still about entertainment, a global player. But the value now seems really rooted in their intellectual property, their IP. Creating it, monetizing it, and making sure that IP works across, well, everything. Physical toys, digital games, movies, shows.
That's spot on. And they've basically formalized that into three core business segments. The first one, and honestly the most valuable by far, is gaming and digital. That's mostly Wizards of the Coast, or WOTC. This is really the financial engine driving the whole company.
Right, we hear WOTC mentioned constantly. What makes it such a powerhouse compared to, say, the part of the company making Transformers or G.I. Joe?
It really comes down to the margins. WOTC is home to these absolute monster franchises like Magic, The Gathering MTG, and Dungeons & Dragons D&D.
Okay.
And this segment covers everything, the physical collectible cards people love, but also increasingly high-end digital gaming. They're even developing major AAA projects like that sci-fi RPG Exodus we keep hearing about. Plus, there's the very profitable digital licensing.
Not Monopoly Go. That was huge, wasn't it?
Phenomenal success. And critically, WOTC delivers these exceptional operating margins. We're talking consistently around 40% to 44%.
Wow. 40 to 44%?
Yeah. I mean, that kind of profit potential, it's almost unheard of in the traditional toy world.
Okay, so that's the engine. Then you've got the consumer product segment, the CP segment. This is the classic stuff, right?
That's the traditional business, yes. Action figures, play school for preschoolers, board games like Monopoly, Clue.
And this part is aiming for, well, a turnaround. Sounds like it's been tougher going there.
It is. It's a difficult multi-year turnaround plan they're working on. And the third piece, entertainment, is really about a shift in thinking.
How so?
They've moved to what they call an asset-light model. So instead of pouring huge amounts of money into their own film studio like they did before.
Right, I remember E1.
Exactly. Now the focus is more on monetizing their IP Think My Little Pony. Transformers through partnerships with third parties, licensing out the rights for films and series. It's designed to be a lower-risk revenue stream. Leverages existing Hollywood infrastructure instead of them having to build and maintain it all themselves.
Makes sense. And underpinning all these segments, we need to talk about the operational side, this playing to win strategy. There are some aggressive goals there, aren't there?
Oh, definitely.
Specifically, that target of achieving $1 billion in aggregate cost savings by 2027.
Yeah.
That's a huge number.
It's massive. And it signals major restructuring is underway or planned. They're looking at everything, supply chain efficiencies, how the organization is structured. And on the supply chain point, you mentioned IP working globally. Well, they're also making a real effort to diversify geographically.
Moving manufacturing.
Trying to, yes. Aiming to significantly reduce their reliance on manufacturing in China over the next few years. That's key for managing geopolitical risk. Hashtag to burn. Competitors and companies' competitiveness. Now, when you look at Hasbro versus its competitors, their main advantage seems to be twofold. First, just the sheer strength and depth of that IP portfolio.
MTG, D&D, Nerf.
Yeah, those are big names.
Huge. But the real game changer, I think, is WOTC. Their unique leadership in that high-margin, integrated analog and digital gaming space. That's something competitors like Mattel and Lego just, well, they haven't really replicated it at that scale or profitability.
Mm-hmm.
And we absolutely cannot forget the power of their strategic licensing deals, especially those vital ones with Disney for massive IP like Marvel and Star Wars. Those are incredibly important. Yeah, the Comboscope report really flags those Disney deals as a major strength. But isn't that kind of reliance also a huge vulnerability?
It definitely is.
I mean, what happens if that Disney relationship sours or a big license doesn't get renewed? Doesn't that pull the rug out from under a big chunk of their products?
It absolutely creates leverage risk, you're right. But you could argue it's a necessary risk, given the unbelievable consumer demand for that IP. They're essentially renting the best real estate on the shelf. But yeah, the report also highlights their exposure to geopolitical risks.
The China manufacturing dependence.
Exactly. Even with diversification efforts, the forecast still sees their Chinese manufacturing exposure at around 30% of total revenue by 2026.
30% is still quite high.
It is, and it leaves them pretty vulnerable to sudden tariff changes or trade tensions.
And what about their direct peers? We're talking Mattel, Lego mainly. What challenges do they present?
Well, Mattel has shown they can be incredibly good at IP revitalization. Look at Barbie, a global phenomenon. They proved you can take old IP and make it massively relevant and profitable again. And Lego, well, they basically own the construction toy space, don't they? It's almost a monopoly there.
So how does Hasbro stack up overall?
When you put it all together, the analysis suggests Hasbro's overall competitive position is actually more defensible.
More defensible. Because of WOTC.
Primarily, yes. That WOTC engine is the key differentiator. Mattel and Lego are, fundamentally, still mostly constrained by those structurally lower toy margins. Hasbro has this 40% plus profit segment they can lean on and invest from. That gives them options the others don't have quite as easily. Hashtag take 3, growth strategy.
Okay, so that leads us to their growth strategy. It sounds very clearly like a two-pronged approach. And prong number one is where they're putting most of their chips, right? WTC and digital.
Absolutely. That's positioned as the primary growth engine. The forecast they're aiming for is aggressive, a 13% compound annual growth rate, CAGR, through 2027.
13% CAGR. Maybe just quickly for listeners, that means sustained compounding growth year after year. That's a really high target for a company this size, isn't it?
Exceptionally high, and the drivers they're using for WOTC are frankly pretty smart, especially MTG's Universes Beyond strategy.
That's the IP tie-in thing.
Yeah, we're talking about these cultural mashups using massive external IP like Final Fantasy or Spider-Man to bring completely new fan bases into the Magic ecosystem.
Wait, Final Fantasy cards in Magic? The Gathering. That sounds like, well, like you said earlier, a license to print money.
It's working incredibly well.
Is the idea that these tie-ins are bringing in totally new players? Or just getting existing fans to spend more?
It seems to be both, but the big win is attracting new players who might never have considered MTG before. It's IP harvesting at its finest, really. Plus, they're relying on developing those huge, expensive AAA digital games like Exodus to capture long-term digital revenue from D&D. Get the IP off the tabletop and onto consoles, PCs.
Right, diversifying the D&D experience. Okay, now let's look at prong number two, the CP turnaround, the consumer product side. That sounds like the real heavy lifting.
It is. That's the hard work. They're aiming for mid-single-digit sales growth by 2027. That requires a fundamental shift in how they manage those traditional brands.
What's driving that hoped-for growth?
It's a mix. Innovation in the core toy lines, trying to create new hits. Content tie-ins are still huge, like the anticipation around Disney's Toy Story 5, or they had a collaboration for that Netflix film, K-pop Demon Hunters. And structurally, it's about mitigating those tariff headwinds through diversifying the supply chain, as we discussed. And also, Hasbro is actively restructuring the CP portfolio itself. They're really focusing resources on just 15 core mega brands.
Only 15. What happens to the rest?
Letting less profitable or less established lines essentially fade away, it seems. The idea is this focus, combined with reducing inventory levels at retail, should make the whole segment leaner, more responsive.
And we can't forget licensing again here, can we? Those high-value, asset-light deals, particularly Marvel and Star Wars.
Exactly. They continue to provide this steady, higher-margin revenue stream with almost zero operational risk for Hasbro, since they aren't making the movies or shows themselves. It's just reliable revenue. Stability. Hashtag TAC 4. Execution risk. Okay, but let's talk vulnerability. Where could this all go wrong? The biggest execution risk, hands down, is that heavy dependence on WOTC for basically all the profit growth.
Right. If that 13% CAGR doesn't happen,
The whole investment story looks very different, and this risk shows up in a couple of main ways. First, maybe consumer engagement in D&D or MTG slows down faster than expected, perhaps fatigue sets in, or oversaturation. Second, and this is a big one, the underperformance of those really expensive digital gaming launches they're banking on.
yeah, you mentioned those AAA game projects earlier, like Exodus. Remind us about the scale of that financial commitment. Why are these launches so make or break?
Absolutely. Look, think blockbuster movie budgets. But instead of selling tickets for 2 hours, they need to hook gamers for months, maybe years, just to recoup the investment. The company itself has noted development budgets for these big AAA video games can range from $100 million up to $250 million per game.
Wow. $250 million.
Yeah, and if you look at their balance sheet, they've got around $350 million in capitalized software costs currently for their whole game pipeline. Now, here's a kicker. When a huge game like Exodus finally launches, roughly 65% of its entire capitalized development cost hits the cost of goods sold at IGS in that single launch quarter.
65% hits the books immediately.
Immediately. So the pressure for these digital projects to be hits, and not just modest hits, but big sustainable ones, is immense if they want to keep WKC's margins up in that 40+% range. If a game bombs, that huge expense just obliterates profit very quickly.
Oof. Okay. And meanwhile, back in the consumer product segment, that's still a massive question mark, isn't it?
Yeah.
High execution risk there, too.
Definitely. Declining retail sales trends historically, those structural issues like tariffs, supply chain costs, it's a tough environment.
So how does the overall risk balance out?
Well, that's why the net risk assessment is this careful balancing act. Yes, the CP division faces significant challenges, both operational and market-based, but the established stability and, crucially, the exceptionally high profitability of WOTC acts as a powerful counterweight. This diversification, having that high margin engine, arguably creates a more balanced, maybe even lower risk growth trajectory for Hasbro overall, compared to peers who are completely reliant on the notoriously volatile cycles of traditional toy innovation. Hashtag Tech5, recent business updates and business trends, Q3 2025, and financials.
Okay, let's pivot then to the very latest data. We have numbers from the Q3 2025 earnings call, which happened back in October. What were the headlines?
The headlines looked pretty solid, actually. Net revenue was up 8% compared to the same quarter last year. Adjusted operating profit also up 8%.
Decent growth.
And they guided that full-year revenue growth is expected to land somewhere in the high single digits. So, trending positive overall.
And WOTC's performance in that quarter.
Wizards of the Coast was the undisputed star, no question. Year-to-date, revenue for WOTC was up a phenomenal 40%.
40% year to date. That's huge.
It is. And that Universes Beyond strategy we talked about, absolutely crushing it. The Final Fantasy set for MTG, for example, they called it a record-breaking set in the game's history. And the pipeline for 2026 looks just as packed. They mentioned upcoming collaborations like Teenage Mutant Ninja Turtles, The Hobbit, Star Trek, suggests they think this model has legs.
Right.
Even D&D is showing really strong momentum.
Yeah.
They launched a new virtual tabletop feature on D&D Beyond, and apparently weekly traffic was up nearly 50% since its launch in September.
Okay, so WOTC firing on all cylinders. What about consumer products in Q3? Any signs of life in that turnaround?
There were some encouraging signs, yeah. Sequentially, the segment showed improvement, and importantly, they saw a mid-single-digit increase in point of sale, or POS, starting in late August.
And POS, just to clarify for everyone, that's actual sales at the checkout counter, right? Not just Hasbro shipping boxes to stores.
Exactly. It reflects real consumer demand. So seeing newer products like Manimals and DJ Furby gaining traction at POS suggests consumers are responding at least somewhat to their innovation efforts. However, the outlook for the full year for CP is still expected to be down mid-single digits. Primarily, they say, impacted by those persistent tariffs.
Ah, the tariffs again. Speaking of those and other financials, what else stood out from the Q3 numbers about the company's overall health?
While WTC's health is exceptional, operating margin was 44% in Q3. Just stellar. On the debt side, they seem to be managing things well. They reiterated they're on track to hit their 2.5x leverage target by the end of 2025.
And hitting that leverage target is important because
it signals to the market that their debt level is under control, that the cost savings and the growth from WOTC are actually helping them manage their financial obligations effectively. It builds confidence. The total tariff impact for 2025 is still pegged at $60 million, though. That remains a significant headwind they have to fight against.
$60 million just from tariffs?
Ouch. And inventories. Heading into the crucial Q4 holiday season, how were retailers stocked?
That was an interesting point. Apparently, retail inventories were down mid to high teens coming into Q4, so retailers were running quite lean.
Lean is good, usually means less markdown risk.
Right, but Hasbro said they saw accelerated orders coming in and expected that deficit to be cut in half by year end. So it signals healthy demand. Retailers were running lean, but needing to replenish quickly for the holiday rush. Hashtag 6. Keys to watch. Okay, so to wrap things up, looking forward, the CompaScope report highlighted 5 really critical factors that you, the listeners, should probably keep a close eye on. Number 1, and this feels like the most important by far, the performance and growth of Wizards of the Coast and digital gaming.
Absolutely essential.
You have to watch the success of new product lines like Universes Beyond, and critically, the performance of those big, expensive AAA digital titles, especially Exodus.
Number 2, consumer demand for toys and games. Can Hasbro actually pull off that turnaround in the lower margin consumer products segment? Can they overcome those tariff headwinds? If they start missing that mid-single digit growth target for CP, the market might react negatively.
Number 3, licensing partnerships and IP monetization. Keep a really close eye on those core deals, especially with Disney for Marvel and Star Wars. Any change there could shift billions in potential revenue, couldn't it?
Easily. 4, execution of cost savings and operational efficiencies. Are they actually hitting that huge $1 billion savings goal by 2027? And crucially, where is that money being saved? Is it sustainable efficiency, or are they maybe cutting too deep into things like R&D?
Good point. And finally, number 5, geopolitical and supply chain risks. Specifically, how they manage that ongoing reliance on Chinese manufacturing and navigate that persistent, costly $60 million annual tariff impact.
So if you synthesize all of that, Hasbro is fundamentally a company that's successfully leaning on its established super high margin digital assets, WOTC, to basically fund the necessary but difficult turnaround of its traditional lower margin toy business.
Yeah.
They're kind of buying time and using those digital profits to fix the analog problems. That's really the core tension defining their whole investment story right now.
Exactly. It feels like Hasbro is betting the farm on Wizards of the Coast, which means effectively they're not just a toy company anymore, are they? They're maybe more like a high-risk, high-reward digital publisher that just happens to also own Monopoly and Play-Doh. That's a fair way to put it.
And given that sustaining those incredible 40+% profit margins in WOTC requires massive continued success, the question maybe for you to think about is, can they really manage a potentially $250 million digital game launch like Exodus while simultaneously fixing a multi-billion-dollar traditional toy division?
Mm-hmm.
That balance between their analog IP strength and the sheer execution risk in digital.
Well, it's never felt more delicate, has it? Thank you for joining us for this deep dive into Hasbro. We'll talk to you next time.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.